As we approach the opening bell on Friday, November 7th, 2025, the market is delivering a brutal verdict on Opendoor Technologies. The stock, ticker OPEN, is currently indicated at $5.04 in pre-market trading. That is not a minor pullback. It is a catastrophic collapse, representing a drop of more than 23% from yesterday's closing price of $6.56. This is the moment where the narrative meets the numbers, and the numbers have just staged a hostile takeover. For the thousands of retail investors, the self-proclaimed open army who championed this stock all summer, this morning is a devastating wake-up call. The expectation was that the company's pivot to an AI-first model and the energy of a new chief executive would finally prove the iBuying model resilient. The reality, delivered via last night's third-quarter earnings report, is that Opendoor is not immune to the crushing weight of the housing market, and its problems are getting worse, not better. The source of this pre-market implosion is that Q3 earnings report, which failed to meet expectations on almost every critical metric. The company reported a loss of 12 cents per share, significantly missing the consensus analyst estimate, which called for a loss of only 7 cents. Revenue also came in light at $915 million, short of the $922 million consensus. But the headline numbers do not even begin to tell the story. The real damage is in the operational details, and most importantly, the forward-looking guidance. Opendoor sold only 2,568 homes in the quarter, a steep decline from the 3,615 it sold in the same period last year. Even more alarming, its purchases have fallen off a cliff. The company acquired just 1,169 homes, a staggering drop from the 3,504 it bought a year ago. This signals a company in full retreat, unable or unwilling to deploy capital in the current environment. Its gross margin shrank to 7.2%, meaning it is making less on each sale. And perhaps the most terrifying metric of all, the company's inventory is getting old. A full 51% of its homes have been sitting on the books for over 120 days. That is up from just 23% last year. In the iBuying business, inventory is like produce. It rots. Holding a house for that long in a high-interest rate environment is a recipe for financial disaster. The expectation, particularly on forums like Reddit and X, was that Opendoor's massive short interest was fuel for a squeeze. The story was that the new CEO, Kaz Nejatian, was building Opendoor 2.0, a lean, technology-driven platform that would crush the shorts. That narrative powered the stock from under $1 to over $10 this summer. The reality is that the fourth-quarter guidance provided by management just handed the short sellers a massive victory. Opendoor is forecasting that its revenue will fall again by as much as 35% sequentially in the next quarter. It also guided for an adjusted EBITDA loss between $45 and $55 million. This is not a turnaround. It is a confirmation that the core business is contracting at an accelerating rate. The market's reaction is not just about a single bad quarter. It is a full-scale repricing of the company's future viability. The open army was betting on a recovery, but the company itself is now guiding for a deepening winter. This brings us to the intense battleground of short selling. Opendoor is one of the most heavily shorted stocks on the market. As of the most recent data, over 161 million shares are held short, which accounts for more than 22% of the company's entire float. This is an enormous position. Naturally, many retail investors see a number that high and immediately think short squeeze. This is the expectation. But the reality is far more complex, and investors need to understand this. A high short interest alone does not signal a squeeze. You must look at the cost to borrow the shares. Right now, the borrow fee rate for Open is incredibly low, at less than 1%. When a stock is difficult to borrow and shorts are desperate, that fee can spike to 50, 100, or even 300%. A low fee combined with a high short interest tells a different story. It suggests that large institutions are not panicking to cover their short positions. Instead, it signals that the supply of shares available to borrow is plentiful and that the conviction among short sellers is high. They are not scared, they are comfortable. For investors, this is an actionable insight. You can find this data yourself. Short interest percentage is available on many financial sites, and you can often find borrow rates from major brokers. When you see a high short interest but a very low borrow fee, it is a warning sign. It means the smart is not trapped, it is confident. What's your take on this setup? Do you believe the low borrow fee is a sign of overwhelming institutional conviction, or is it the calm before a storm? Let me know in the comments. The shorts are betting that Opendoor's business model is fundamentally broken in a high-rate world. Their thesis is that Opendoor is a house flipper that depends on high transaction volume and stable or rising home prices. In today's market, with mortgage rates high, affordability at multi-decade lows, and transaction volume frozen, that model bleeds cash. Yesterday's earnings report, with its shrinking margins, aging inventory, and bleak guidance, was a direct confirmation of that short thesis. The pre-market drop to $5 is not a retail-driven panic. It is the market rapidly agreeing with the short seller's fundamental analysis. Let's briefly touch on what Opendoor actually does for those who are new to the story. Opendoor is the pioneer of the iBuying or instant buying model. The idea was simple. Use data and algorithms to make an instant all-cash offer on a person's home, buy it, make light repairs, and resell it on the open market for a small profit. This process would replace the traditional slow-moving real estate agent model. During the zero-interest rate environment, the model worked, or at least appeared to. The company could buy thousands of homes, and the rapidly appreciating housing market covered up any mistakes in its pricing algorithms. But when the Federal Reserve began its aggressive rate-hiking cycle, the music stopped. Suddenly, buyer demand vanished, and Opendoor was left holding billions of dollars in inventory that was losing value every single day. The company has since been in a desperate fight to survive, shedding inventory, laying off staff, and now pivoting its narrative to focus on software and its marketplace rather than its own balance sheet. The new CEO has been adamant that Opendoor is a software company, not a hedge fund waiting for macro to turn. The company is pushing its Opendoor 2.0 strategy, which involves partnering with builders and offering services to third-party sellers, aiming to be more of a platform and less of a flipper. The goal is to achieve adjusted net income profitability by the end of 2026. This was the expectation that investors were clinging to. But the reality of the Q3 report shows that this transition, if it is happening at all, is not happening fast enough to offset the collapse of the core iBuying business. The company is simply not buying homes because it cannot sell the ones it already owns at a profit. That 51% of inventory sitting for over 4 months is the anchor dragging the entire ship down. Analyst price targets reflect this grim reality. Even before this earnings disaster, the consensus target was a meager $1.62, with the most optimistic bull case on Wall Street only seeing a high of $6, a price the stock just crashed through in pre-market. Looking ahead, the path for Opendoor is treacherous. The company's future is no longer in its own hands. It is entirely hostage to the Federal Reserve and the U.S. housing market. The bull case requires a significant, rapid decline in mortgage rates to unlock transaction volume, combined with a stabilization in home prices. If that happens, Opendoor might have a chance to clear its old inventory and prove that its new, supposedly more accurate AI pricing models can work. The bear case, which is what the market is pricing in today, is that rates stay higher for longer. In this scenario, housing remains frozen. Opendoor's aging inventory continues to generate massive losses, and the company's cash burn becomes a serious concern. The company is guiding for a massive sequential drop in revenue for Q4. That is not speculation. That is management's own forecast. This forces every investor to ask a hard question. Comment below with your thoughts. Do you think Opendoor's management is being realistic with its Q4 guidance, or are they still being too optimistic? In summary, the dramatic tension for Opendoor has just snapped. The expectation, held by a loyal retail base, was that this was a technology